Hello friends, Chris Lee CPA here, back with another video for you. In the most recent video, we talked a little bit about how talked about when a transaction is taxable when selling your business. And so specifically focusing on contingent price arrangements when you sell your business, sometimes referred to as an earnout. And what happens when you've got a cap on your earnout versus a time cap on when that earnout can be earned, or none at all. And so talking about when the transaction becomes capital or taxable, and so on. And so now we're going to transition from the when is something taxable to the how is something taxable, what character of income. So when we think about selling our business, we have a couple things to think about. We want to minimize taxes, avoid exposure to business-related liabilities after the sale, and collect the maximum amount of sales proceeds. So those are our three goals when we're structuring for an exit. Minimize taxes, avoid exposure to business-related liabilities after the sale, and again, collect the maximum amount of sales proceeds. So when it comes to operating a entity that is not disregarded, right? It's a C corporation, an S corporation, a partnership, an LLC that is taxed as some sort of corporation or partnership structure. You have two options. You can, one, sell your ownership interest, or two, sell the assets of the business. Okay, so when we're in an entity that files a separate tax return context, we can sell either the interest of the business or we can sell the assets of the business. Now, when we are in the context of a sole proprietorship, or we have a single member LLC that is taxed as a sole proprietorship, often referred to as a disregarded entity, there is not the two options. By default, that is always going to be an asset sale when you sell the business. So an asset sale treatment automatically applies if your business is a sole proprietorship or a single member LLC, treated as a sole proprietorship and you're selling your business. So that's an automatic treatment with that entity structure. So when we are selling our assets, we kind of get dropped into an order of operations with how with the steps that we're going to take from a federal income tax perspective. We are going to take the total sales price for what is functionally a bundle of assets being sold, that is the business, and allocate them to different groups, different specific assets. And so under 1061 of the tax code, we have what is referred to as a purchase price allocation instructions under what's called the residual method. And so we have 7 categories that we break the purchase price down into the assets being transferred. So the assets being transferred can be composed of cash, receivables, inventory, depreciable assets, amortizable assets that are not goodwill, and then goodwill. In total, there are seven classes that hits kind of functionally the major ones. And basically, we take the purchase price, we allocate it to all the assets that are non-goodwill, and then once we've kind of assigned that sales price to all those assets, then the residual gets dropped down to the goodwill bucket. So once we allocate to all of the buckets, basically, we then calculate the taxable gain from the sale of each asset, which is to say the purchase price of each asset minus the basis in those assets, what we paid to acquire those assets, net of any depreciation or write-offs we've taken on those, gives us our taxable gain. Each of those assets are going to have a different character, and so then we calculate the type of tax that will occur on that, whether it's the ordinary income taxes, capital gain, short-term capital gain, long-term capital gain, all those sorts of things. Now, when we do this and we're selling real estate held for more than a year, the maximum tax rate is going to be 25% on the gain attributable to prior depreciation deductions. That is to say, the depreciation you previously took ends up coming forward and being quote unquote recaptured, and depreciation recapture on real estate is up to 25% tax rate. For other assets where we've got recapture, that could be tangible assets that are non-real estate or amortizable assets. So that could have been, purchased intangibles or something like that. The recapture of those prior cost recovery deductions through depreciation or amortization get taxed at ordinary income rates for the gain that is produced from prior deductions. So then after that, we're looking at all the other assets being sold, carrying typically ordinary income tax rates, which go up to 37%. And so that's just something to keep in mind, is that certain types of and that would come down to selling, receivables, inventories, and other assets. So when you sell those are going to be ordinary income tax consequences. And then when you're selling the intangible portions of it, particularly goodwill or other identifiable intangible assets, those are going to be generally long-term capital gain rates, which is kind of the best case scenario and what we want to get out of it. So the most important opportunity, like the biggest strategy that you can implement when you sell assets in general, but particularly in a single member LLC or sole proprietorship context, is allocating the total sales price to specific assets. So to the extent possible, you generally want to allocate more of the price to assets that would generate lower tax long-term capital gains, such as land, buildings, and intangibles, and less of the purchase price to assets that would generate high taxed ordinary income or taxed as depreciation recapture, such as receivables, inventory, furniture, equipment, purchased intangibles, all those sorts of things. So that's kind of what we're looking at when we are selling assets in general, and then particularly in a sole proprietorship context. Now, if your business you've got two options. You can sell your ownership interest, or you can sell the assets. So as the seller, you probably will strongly prefer to sell your ownership interest for two reasons. One, any business-related liabilities generally go away with the ownership interest and become the problem of the new owner. So that's where due diligence becomes more complicated, I will say, because you're trying to look at like what's the exposure on the other side of the transaction. And then second, any taxable gain on the sale will generally qualify as a long-term capital gain tax rate if you've held the ownership interest for more than a year, which is unusual that you wouldn't be in that scenario. Now, the exception to the favorable tax treatment is in the partnership or an LLC interest that's treated as a partnership interest. Partnerships are unique from S corporations and C corporations because they're a bit of an in-between when it comes to how they're viewed for tax purposes. From tax purposes, they have both an entity view, right? Like it sits there as an entity, and it makes elections and all those sorts of things, but it also has an idea that there's an aggregate concept. More than it being separate from the owner, it's just a pool of resources of a bunch of different owners coming together. And so we've got two fighting interests here. Like you've got an interest in all those assets kind of personally versus an entity that holds all of these assets. So within the partnership area of the tax code subchapter K, that's generally what we've got going on. We've got a push and pull of when the tax code is implementing which of those things. Now, when you sell a partnership interest, gains attributable to ordinary income assets, your allocable share of the underlying assets in the partnership, that would be receivables, inventory, depreciated furniture and equipment, those sorts of items. The extent to which you have an ownership, kind of an indirect ownership in those assets, part of your gain is going to be taxed when you sell your LLC interest. It's going to be taxed as ordinary income back to you, and then the residual gain is that long-term capital gain. So this is to prevent a partner from shifting tax consequences from an exiting partner to an incoming partner. So the idea being that this incoming partner didn't generate these receivables or inventory or these potential ordinary income tax responsibilities, and so we can't just sell our interest to generate that consequence. And that's one of the things when it comes to partnerships, is that it's going to spit out a K1 and you take your allocable share and you report it on your tax return. So you have to be conscientious. The code is very conscientious of that in the partnerships. So when it comes to partnerships, the most important thing to think about, to know, is that they are extremely flexible, but they're brutally fair. And that you can't use it as a mean, you can't use the vehicle that is this partnership to shift consequences without shifting the overall economics. And so that's what this provision does. Now, when it comes to the C Corp context, that doesn't really exist. We don't look through in any rate to see the underlying assets. When you sell your interest in a C corporation or an S corporation, almost always you're looking at just a straight up long-term capital gain for the sale of stock, the same way if you bought and sold like an S&P 500 ETF. Like fundamentally, it's a similar concept. It's just more again when you're selling private business versus public shares that are in a regulated brokerage account or something like that. Now, when you're in the context of LP, LLC, all sorts of things. Now, you typically will have buyers preferring asset purchases versus sellers, right? So sellers usually want to sell their stock or sell their interest. Buyers usually want to buy the assets, and that's because they want to purchase the assets, get a step up in the tax basis of those assets, right? Get that fair market value rather than what the original price was, and then that gives them opportunities to depreciate or amortize those deductions of the purchased depreciable and amortizable assets. And so then it also exposes them to more long-term capital gains when the buyer sells or converts into cash and other purchased assets. So buyers typically want asset deals. Sellers usually want stock deals or sales of interest deal. So the selling entity is generally going to allocate that sales price from the transaction, again, to each asset that is sold in the same fashion as discussed earlier. And the nature of the taxable gains and losses is basically the same as described earlier. So the process is fundamentally the same. And then after winding up the sale of assets and paying entity level taxes that may exist, they can exist depending on some certain nuances, particular and an S corporation and partnership. Usually though, the C corporation is the least efficient vehicle for this, selling your assets and then liquidating the entity if that's what you're going to do, rather versus like repurposing it or something. So it's the most inefficient because there are two levels of tax. That's kind of fundamentally the problem with C corporations that pass-through entities try to get around, is the two layers of tax. So if you operate a business as a C corporation, you sell your assets and then you go to liquidate it, there are two things happening. One, the overall taxable gain from the sale of the asset is going to probably result in a corporate level federal income tax bill. So that's our first tax. With the C corporation, the same corporate level federal income tax rates apply to both capital gains and ordinary gains from sales. So there's no like different rates you have to think about that we would if the gain was ending up on an individual return or a natural person return, where you've got ordinary income tax rates with all the brackets, or you've got the capital gain treatment, which has a variety of tax rates that could apply. So the first one is that corporate tax rate right now, 21%. And we've got the second tax, which is the corporation's liquidating distribution paid to you, which can be taxed as a taxable dividend, right? So that's the second tax. So two layers of tax. In an S corporation or partnership, if you operate the business as one of those structures, the gains and losses from the entity level asset sale are passed through to you and taxed at the personal return. So generally, they're not going to have any tax at the entity level. There are certain circumstances where that can happen, but they're usually, it's very unusual, but it can happen. It's just something to be aware of. So then at the entity level, you'll probably have some gains that would qualify, when you do the math. Some are long-term capital gains, and then some that might be taxed at the higher ordinary income tax rates. And that's because the entities are, again, they're pass-through entities. So you'll generally have no entity level tax. You just do the math on the character of the income and then pass it through, which means you don't have to worry about the double tax issue. Now, what does happen is if you have a transaction that's going to close, right? So you close it and it does have those earnout provisions or those contingent considerations. Your entity, right? Like when you sell your assets, you're gonna have to leave that entity open until all of those proceeds are determined to be, paid out and received. And so you're still gonna have entity tax returns for multiple years potentially if you do have that burnout, which means you've got multiple years of paperwork. You'll actually have to keep some money in the bank account, pay for ongoing professional fees related to management and execution of, the accounting, tax, lawyer work, of all that going on within the entity after the sale. So that's kind of what you get. With selling assets from an entity that isn't going to otherwise, ultimately be repurposed into another business venture, or something like that. So that is kind of the lay of the land of how something is taxed. So when we talked about the earnout and talked about contingent consideration, all that stuff, that's talking about when the transaction gets taxed. This video covers the how it gets taxed. So when you sell your assets, you've got different types of gains and losses that are attributed, because it's kind of as though if you took each asset, gave it a purchase price, take what you paid for it net of any prior depreciation expenses or prior deductions on those assets, and generate a gain. And then you've also got the character of it that matters in the context of, a pass-through entity. In the context of a C Corp, doesn't really matter. Pass-through entity treatment versus sole proprietorship treatment, basically the same. Reporting is very different, but functionally, the way it gets taxed is the same. C corporation, when you sell your assets, you get a double tax consequence. Buyers, again, usually prefer to buy assets because they get a stepped up basis on potentially depreciable assets. And so they can, sell those assets, write off those assets sooner, and also have a greater opportunity for long-term capital gains when they sell their assets, if the assets were to be sold again in the future that they purchase. On this, the sale of interest, that's usually preferred by sellers because it ultimately becomes fundamentally most often is a long-term capital gain transaction, and that is usually the preferred result that we want. And so there's also the benefit of not having the liabilities post-transaction. Now, one thing to think about here is if you are structuring a transaction that is the sale of interests, a lot of times we will want to have real estate not held in a C corporation. So if you're buying interests, or an S corporation, even if you're buying a business, potentially it's buying the interests of a business, and you're seeing that there's real estate in there that you would like to not be in there, you can actually have two transactions going. So rather than saying the whole transaction is a purchase of the underlying asset in a corporate context, rather than saying, hey, we're going to buy all the interest, you could have a separate transaction to buy the real estate from a separate entity that's not a C Corp. And then from there, so you buy the real estate, put it into a new entity that's not a C corporation, buy the remaining interests in the entity, and now you've taken it out and reduced your exposure for a taxable transaction if you were to, for whatever reason, restructure that real estate in a transaction that is not a tax-free reorganization. So that's sometimes to think about, is that we can do a combination of a transaction that is both interest and a specific asset, or a small group of assets rather than the whole thing. So sometimes you can do a transaction that is a bit of both and not just all or nothing. So that's one thing to think about in these transactions. But with that, if you want to get in touch and discuss anything in your tax structuring, tax issues that you've got going on, click on the link in the video description, and I'll be back soon with another video. Take care. Bye.